Chase Bank is currently paying 0.01% interest on standard savings accounts. That is 1 cent of interest per year on every $100 you deposit. The current U.S. inflation rate is approximately 3.1%, which means every $100 sitting in a Chase savings account is losing $3.09 of real purchasing power every single year. While Chase uses that same $100 to generate returns that are anywhere from 8 to 24 times higher than what they are paying you. This is not an accident. It is not an oversight. It is a business model. And it is one that most Americans have been participating in their entire lives without ever seeing the numbers clearly. This video is about 4 things your bank has never told you about your savings account. Not to make you angry, to give you the information you need to make better decisions about where your money actually sits. We are covering what banks actually do with your deposited money, what the real cost of low-interest savings is in actual dollars, what the alternatives are and how they compare, and the one account type that pays 10 to 50 times more interest for zero additional risk. This is Wealth Clarity. Let's get into it. Let us start with the part of banking that most Americans never think about. Because if you understood this, you would evaluate your savings account completely differently. When you deposit money in a bank savings account, you are not storing money. You are lending it. The bank takes your deposit and uses it as capital to issue loans, mortgages at 6.5% to 7% annual interest, auto loans at 7 to 9%, personal loans at 10 to 15%, and credit cards at 18 to 24%. Your $100 deposit becomes part of the pool that funds all of these products. The bank earns somewhere between 6 and 24% on your money depending on the product. Then it pays you back 0.01%, the rate on a standard Chase or Bank of America savings account in 2026, and keeps the difference. That difference has a name in banking. It is called the net interest margin. And for the major U.S. banks, it is one of their largest and most consistent sources of profit. To be clear, this is not illegal. It is not secretly immoral. It is exactly how banking works and always has. Banks are in the business of intermediation. They borrow cheap, lend dear, and keep the spread. Your savings account is the cheap borrowing side of that equation. But here is what changes when you understand this. You stop thinking of your savings account as a place where your money sits safely. You start understanding it as a financial product, one that generates significant returns for the bank and minimal returns for you. And once you see it as a product, you can evaluate whether it is the right product for the job your money needs to do. Let's put this in numbers that make the asymmetry visible. You deposit $10,000 in pesos in a Chase savings account at 0.01%. After 1 year, you have earned $1. $1. Chase takes your $10,000, lends a portion of it through a credit card at 22%. On that same $10,000, the bank earns approximately $2,200 in a year. They earned $2,200. They paid you $1. The remaining $2,199 is the margin they kept. You assume the risk of leaving your money with them. They captured nearly all of the return. The second thing your bank never tells you is the real cost of keeping money in a low-interest account, not in vague terms, but in specific calculable dollars. Inflation is the rate at which money loses purchasing power over time. The U.S. Federal Reserve targets 2% annual inflation as a policy goal. In 2026, inflation is running at approximately 3.1%. Every year your money earns less than the inflation rate, it is losing real value. Here is what that looks like in real numbers across different time horizons. $10,000 in a standard savings account at 0.01% over 10 years grows to $10,010. The same $10,000 needed to grow to $13,493 just to maintain its purchasing power at 3.1% annual inflation. The gap between those two numbers, $3,483, is what inflation quietly took from your savings over 10 years while you were being responsible. Over 20 years, the same calculation shows you with approximately $10,020 in the account, versus needing $18,170 to maintain purchasing power. The gap widens to over $8,000. None of this appears on your bank statement. Your balance goes up by a few cents each year, and on paper it looks like you are earning something. In real terms, you are losing ground every single month. The bank never presents it this way, because presenting it this way would prompt you to ask the obvious question: why am I keeping my money here? Here is the core belief that banks benefit from you holding: that a savings account is the safe choice, that anything with a higher return must come with higher risk, that the 0.01% rate is simply what savings accounts pay and there is nothing to be done about it. None of those things are true. High-yield savings accounts at FDIC insured online banks are paying between 4 and 5% annual interest in 2026. Same FDIC protection as Chase. Your money is insured up to $250,000 per depositor either way. Same next-day or two-day liquidity. Same basic function. The only material difference is the interest rate, which is between 40 and 500 times higher at an online bank than at a traditional major bank. The safety of a 0.01% savings account is not financial safety. It is the safety of familiarity. Those are not the same thing. So what should you actually do with the money that belongs in savings? The most immediate upgrade, the one that takes 20 minutes and involves zero additional risk, is switching your emergency fund from a traditional savings account to a high-yield savings account at an online bank. In 2026, the following FDIC-insured online banks are offering the highest yields on savings accounts. Marcus. By Goldman Sachs, Ally Bank, SoFi, and American Express high-yield savings are consistently among the top options, with annual percentage yields ranging from 4 to 5%. Here is what that difference looks like on a $10,000 emergency fund over 5 years. At Chase, 0.01%, your $10,000 grows to $10,005 after 5 years. At a high-yield savings account, 4.5%, your $10,000 grows to $12,460 after 5 years. Same amount deposited, same FDIC protection, same ability to withdraw whenever you need to. $2,455 difference from one 20-minute account transfer. This is not investing. This is not risk-taking, allocating. This is choosing between two products that offer identical safety and selecting the one that pays you 40 to 500 times more interest. The practical step is straightforward. Open a high-yield savings account online. Most can be opened in under 15 minutes with just your social security number, a government ID, and your existing bank account information for the initial transfer. Move your emergency fund, 3 to 6 months of expenses, into the new account. Keep your checking account at your current bank for day-to-day transactions. The high-yield account earns interest on your emergency buffer while remaining fully accessible when you need it. Here is the context that makes all of this matter beyond the interest rate difference. The reason your emergency fund should be in a high-yield savings account is not primarily about the interest, though the interest is real money and worth having. It is about the mental accounting it forces. When your emergency fund is separate from your checking account and sitting in a dedicated high-yield savings account, it stops being accessible spending money and starts being what it is supposed to be, a financial buffer for genuine emergencies. The mild friction of a 2-day transfer window actually protects your emergency fund from impulse spending in ways that a savings account at your primary bank, linked instantly to your debit card, does not. The interest rate upgrade and the behavioral protection are two separate benefits working simultaneously. Both are significant. Neither requires taking on any financial risk. Let's close with a framework that makes all of this practical, because understanding what banks are not telling you is only half the value. The other half is knowing what to do with the information. Your money should always be working. The question is what job each dollar is doing, and whether that job is matched to the right account. The first job is short-term safety. Money you might need in the next 1 to 3 years belongs in a high-yield savings account. Emergency fund, upcoming large purchase, near-term life transition. This money needs to be accessible and protected. The right account is an FDIC insured high-yield savings account paying 4 to 5%. It should not be in a standard bank savings account earning 0.01%, and it should not be invested in the stock market where a short-term dip could affect its availability when you need it. The second job is medium-term growth with moderate stability. Money you do not need for 3 to 5 years but want to protect from significant loss can go into certificates of deposit, treasury bills, or bonds, all of which currently offer meaningful yields for Americans willing to lock up funds for a defined period. A 5-year CD at a reputable bank or credit union is currently paying between 4 and 5% with full FDIC protection. The third job is long-term wealth building. Money you do not need for 5 or more years should be invested, specifically in a low-cost total market index fund inside a Roth IRA, traditional IRA, or taxable brokerage account. The stock market's historical real return of 7% after inflation over long periods is the only widely available mechanism for ordinary Americans to grow wealth significantly faster than inflation over decades. Your standard bank savings account should be doing exactly none of these 3 jobs. For the first job, a high-yield savings account does it better at no additional risk. For the second and third jobs, a savings account is structurally the wrong tool. The bank never explains this framework to you because the bank's interest is in keeping your money in their low-yield products, not in directing you toward the accounts that serve your financial interests most effectively. Here are the 4 things your bank has never told you. First, they are lending your money at 6 to 24% interest and paying you back 0.01%. The difference is their profit. Your deposit funds their business. Second, at 0.01% in a 3.1% inflation environment, your savings account is losing real purchasing power every year. Over 10 years, that loss is measurable in thousands of dollars. Third, high-yield savings accounts at FDIC-insured online banks pay 4 to 5% in 2026. The same protection, the same liquidity, 40 to 500 times more interest. Most Americans have never switched because they did not know the gap was this large. Fourth, your money should have a job that matches the right account type to the right purpose. Short-term safety belongs in a high-yield savings account. Medium-term belongs in CDs or treasuries. Long-term wealth building belongs in a low-cost index fund. None of this was on your bank's website. None of it was in the welcome email when you opened the account. But the money is yours, and the decisions are yours to make with it. If this changed how you think about where your money sits, subscribe to Wealth Clarity. New videos every Wednesday and Saturday. YouTube is going to show you the perfect next video right now. I will see you there.